At the start of February 2021, I posted a video effectively warning investors about the ARK ETFs, suggesting that there could be a potential huge drawdown. This video was largely based on the thoughts of Dr. Michael Burry, who predicted the great financial crisis, and outside of that has also been an exceptional investor in several deep value investments. He called the potential risk of a deep drawdown, and I was just bringing that to the public attention. Since that video, since that warning video, the ARK Innovation Fund, or ARKK, one of ARK Investment Management's largest ETFs, managed several $billion in this product, is down nearly 30% in just a few weeks since I posted that video. Several other similar structurally themed funds are down comparable amounts. Now, ARK investors are wondering, like, hey, what the heck? This was supposed to be the great ride that's been going on for the last few years, and it has been a great ride. Let's not, paint it that the prior few years were fantastic returns, but the last few weeks have been brutal. Losing 30% of your value, if that was your human body weight, it would be deathly if you lost 30% in just a few weeks. And so people get nervous in those situations. They're wondering, when does this bloodbath end? In this video, I'm going to discuss what's been going on, why have these ARK ETFs been getting slaughtered, and when might the funds find a potential bottom. First, a quick plug, if you will, where my name is Daniel. You're watching Unrivaled Investing. This is a no-hype, mission-focused channel to try to find exceptional companies and unrivaled investments. If you enjoy learning about potential multi-baggers, types of companies that can go up potentially hundreds or thousands % over time, please make a point of hitting that subscribe button. If you're already a subscriber, smash that like button right now. And if you want to follow my personal journey to see what potential multi-baggers I'm finding, go to unrivaledinvesting.com, click on Journey. Let's dive into what's going on with the ARK ETFs, the various different ARK funds, to understand when might we just have a bottom with these products. So first, a little context. I did post this video, calling ARK watch out. And I'm, for a little context, I am impressed with first of all, what Cathie Wood, her investment track record over the last few years. I'm impressed with the asset gathering that she's done at ARK. People love the narratives of these structural, themed, structurally, you're going to have these long tailwinds. We want to own this theme, genomics, AI revolution, innovation. So people love the product. I'm impressed with the idea and the ability to asset gather. But when Dr. Michael Burry talks, I definitely want to listen, and that's the reason why I posted this video, sharing some of the concerns that he called out and called out in other publications. So you can watch that full video that discusses sort of the liquidity concerns, valuation concerns, the momentum concerns that was brought about, and I would say has been partially addressed since that 30% drawdown. So fast forward, down 30% approximately. Several of the comparable funds or similar funds are down comparable amounts. Why? What's going on? In the words of Chamath Palihapitiya, earlier today, he was actually tweeting. And so a lot of people consider him the SPAC king. He's had an incredible investment track record. He's personally worth, he said, somewhere between $10 and $15 billion. Might be a little bit less now after the dramatic sell-off, but generally when he speaks, it's also worth listening. I'm not necessarily saying you need to act on it, but I am saying you need to listen and consider what his point of view is, because he is one of the sharp players at the card table. And so what he's saying, he's doing a quick recap in this Twitter post where he's saying fears of inflation have driven many institutional investors to the hills. There are unwinding trades that have worked for decades. I think he's really right about this, in that lower interest rates has been a tailwind that investors have benefited from for decades, and that's been a game that the central banks have been able to play constantly. Every cycle they've been able to lower rates for decades. Since the Fed broke the back of inflation in the early 1980s, this has been a secular advantage for U.S. stocks, which is that every cycle the Federal Reserve can lower rates, and that can create an advantage in terms of helping that recovery. You lower rates, it sort of spurs, helps the economy get back together. It keeps going. Eventually you reach this sort of bottom interest rate, and it starts saying, well, wait a second, are you losing control potentially, where bond market vigilantes, potentially inflation takes over? And so this is where the fears of inflation have driven many institutional investors to sort of reflect that the trade of the last few decades may not work. The last 4+ decades may not work And you know what? We might need to revisit actually what's going on. I actually called this very risk out to my Journey subscribers in an exclusive video over a month ago, in actually a couple of different posts. One was called The Importance of Narratives, to understand sort of which narrative is driving the market. And there's a lot more detail to it, so if you're interested, you can click on it. And the other is, where are we in terms of sizing up, where are we in the markets in terms of thinking about valuation and general sentiment. And Chamath continues where he goes, factor rotation. So this is sort of responding to those inflation risks, where he's saying factor rotation out of tech and into more defensive cyclical stocks that tend to do better during times of inflation. Okay, so this is a very logical move. People are trying to make some sort of rotational bet, saying, hey, if interest rates go higher or if yields go higher, then super long dated, long duration assets aren't going to be that attractive. The longest dated assets in terms of duration is equities that are unprofitable, because you're effectively making a bet that they will be generating immense amounts of profit much later on. And that also coincides with what a lot of you'll find in the ARK investment ETFs, is this super long duration assets, these equities that are unprofitable. They are growing, but it's unprofitable, and that does take a hit with higher inflation, higher interest rate risks. He continues, commodities have spiked, which tend to do better during inflation. Once again, think about this as a duration. So duration is how long does it sort of take for it to play out. And so commodities, this is super short duration asset. It's something that's going to be delivered later this year or later, in a couple of months. Whereas stocks that are going to be generating profits potentially years from now, most of that value is coming from years, potentially 5, 10, 20 years down the line. So when you raise your interest rate, you raise your discount assumption, that has a big impact on your equity valuations. Bonds have puked as yields have risen as they forecast inflation. We'll talk about that in just a second. This inflation, is this warranted? He continues saying, look, you have this $1.9 trillion stimulus bill, potential for $3 trillion infrastructure stimulus bill, and another several trillion stimulus bill in the offing will give inflation fears more juice. I think this is absolutely right, which is that these inflation fears aren't unwarranted. They're based on factual ideas of, hey, we are just going, the deficits are going hyperbolic. They're doing crazy. And the question is, how are we going to finance that? If there's this sort of gap between generating these deficits and trying to figure out how to finance it, yields start going up. And so that's the question. So what will investors do? Chamath continues where he goes, look, there are no easy answers for the next several weeks except to go back and rework, re-underwrite everything we own. Look at our forecast, look at our sizing, look at our risk, and be okay owning them as we stress test our holdings under various potential scenarios. I love the fact that he uses this sort of sweat emoji, like, yeah, it's going to be all right. I hope it's going to be all right. Like, that's, in my mind, this is exactly what's playing out in the market. He's 100% right in terms of calling this out. Keep in mind, I don't always agree with Chamath. You can look at a lot of the SPAC videos that I've done on various different SPACs. Like, most of the time, I don't like the risk reward for them. Heck, I was talking about Clover back when it was 16 bucks a share and saying, look, I don't like the risk reward. Now it's single digit. So, I call this out in a bunch of different videos. So I'm not always saying, hey, I love what Chamath is doing. When he's right, though, it is worth calling out, in my opinion. In this case, I think he's nailing it on the head, which is that investors in the marketplace are saying, you know what, we need to re-underwrite, reconsider our investment thesis, because what if we're using a discount rate that's 5% higher 5 years from now or 3 years from now? What if inflation, God forbid, goes to 10% in a few years from now? Like, how does that dramatically revalue everything? And that sort of, even though that's what I would argue is very much a tail risk, that would have huge repercussions for all equities. If you could get a 10% yield owning bonds, keep in mind, this is a crazy tail risk. If you could get a 10% yield owning treasury bonds, then that automatically means you have to be growing at a really good clip and quite possibly to be quite profitable in order to justify that sort of risk reward, because that's the equivalent of a 10 times PE multiple for a lot of stocks that are trading at 20, 30 times sales. So that's why you start getting this sort of I need to revisit. He also talks about, we want to look at our sizing. How much do we own? Are we going to be selling into this as we start getting a little panicky? So it is worth considering. And so you think about that range of 5 to 10% potential inflation. Now, I'm not saying that's going to happen, but the risk is getting elevated based on fiscal deficits based on this sort of fiscal spending. Now, what does all this have to do with ARK? So as we look at ARK, first of all, that inflation interest rate risk is very real. And here's a picture of the stock chart for IEF, which is the 7 to 10 year treasury bonds, iShares Barclays. So if you wanted to trade, what's going on effectively with the treasury yield curve and you don't have access to buying, let's say, bonds in bulk, this is a good way for retail investors to consider, trading it as a vehicle. And you can see that it's dramatically sold off over the last few months. It's been one of its biggest moves in history. And the risks of inflation, as I've already suggested, are real based on this sort of multi-trillion-dollar deficits, huge percentage of GDP. And, but I would say, I want to temper this a little bit. These concerns, structurally, absolutely a real concern. Structurally, this can continue. This can definitely continue. But in the very short term, and I don't put a lot of weight on short-term analysis, but in the short term, it's very possible you could get some sort of dead cat bounce, or, if this turns into a bear market, this could turn into a bear market rally, because it's just so dramatically, the treasury bonds are so dramatic, US treasury bonds are so dramatically oversold over the last few months that it is possible you sort of get this rebound back to, let's say, a 200-day moving average. You typically do see those types of moves when things do get oversold. So it is possible you do get another bid for treasury bonds. That's the risk, the real risk of higher yields, higher rates is definitely there, and it is a structural risk. It is not just a pie in the sky risk. So it's possible that this negative trend just keeps on going, which does have a big impact on long duration assets, like many of the unprofitable stocks that, yes, they're highly innovative and they find themselves in ARK's innovation ETF, but the most of the value comes from, let's say, 5, 10, 20 plus years from now, when the companies are theoretically much, much more profitable. And if you have higher rates, that future profitability gets severely discounted and definitely does hit valuations. Another key aspect to consider: when could the ARK ETFs bottom, or particularly here's ARK, calling out the ARK Innovation Fund. Tesla is one of their largest positions, and Tesla's forward price to sales multiple has gone up dramatically over the last few years. And here it is. This is the price to sale multiple chart for Tesla. And so you can see that it historically ranged from from around 1x sales to a high of 3x sales. And that's the way it was for years. Fast forward to the last year and a half, and then you have this dramatic re-rating in terms of the valuation, going from 3x sales to up to 20x, recently down to 12x forward sales. So investors in Tesla stock, which includes the ARK ETFs, as Tesla is one of the, if not the largest position at this time in the ARK Innovation and a couple of the other ETFs, the ARK ETFs, is that, and I think it's an outsized position as well, in that this is a huge multiple expansion. It's very possible, and this multiple expansion has been the biggest driver of your return over the last few years. And so you need to understand, over long periods of time, multiple, regular Journey subscribers know, I call this out regularly. Valuation expansion is wonderful in the short term, but you generally don't get it in the long term. Over a multi-decade time frame, valuation expansion is close to nil, close to zero. So this has been a nice ride, everybody, but you should understand that longer term periods, it's driven by fundamentals. It's going to be driven off of, let's say, the success that Tesla has. We'll talk about that in just a second. So I would argue, this is the counterpoint to getting sort of a short-term rally because bonds are oversold. I'd say it's possible, you might not get a true bottom in these ETF products, the ARK Innovation Funds, until valuations also find support. And we are nowhere near that when you look at some of these, some of their top holdings like Tesla. And Tesla, as I've already pointed out, it is an outsized position, 10% plus at this time for a few of the ARK ETFs, such as the Innovation Fund or ARKQ as well, with different ETF, which is the autonomous, like the AI ETF. I've already done a video talking about my concerns with the ARK valuation model for Tesla. I'll also leave a link to that below in the description of this video. And I called out a lot of the risks, such as that the forecast that ARK is using to value Tesla is even more aggressive than what Elon Musk is pitching. And one should call out that something like 80% of the value in their upside case, it's something like this, it's like 70-80% of the value is not actually from the sale of these EVs, but it's from this incredibly lucrative potential robo-taxi fleet that gets rolled out over the next 5 years in a hyper way, where you have literally trillions of miles driven by this robo-taxi fleet. This, keep in mind, this is not my words. This is the assumptions from the ARK, the ARK investment model. And in this video, I sort of try to parse through it, try to take a rational take on it. And so since then, since I did that video, within 24 hours of doing it, Cathie Wood, she was getting a little bit of flack on Twitter, for the model, and so she's sort of responding to it, and you go girl, I love it. Saying, look, you guys are missing these points, and here's the bull case, and trying to like lean into it. And so she's saying, oh yes, I forgot to mention how scarce exponential growth opportunities are likely to become as artificial intelligence creates more winner-take-most opportunities like autonomous taxi networks. Okay, so she's leaning into her thesis saying, look folks, this bull case driven by this robo-taxi fleet, it's going to be driven like you're not going to be able to compete because artificial intelligence, because winner-take-most dynamics, where you become the dominant player that gets this fleet. But then Elon Musk actually responded to this tweet, once again saying effectively, you're being too aggressive on the assumptions. When vast amounts of manufacturing are needed, as in robotaxis, this slows down rate of introduction, so maybe more like winner takes a quarter. Still great. Yes, a robotaxi fleet that you're just minting money off of is still great, but he's like, even Elon Musk is sort of dampening it, like, whoa, you're getting a little too you're going full bull on this. And you're getting a little too aggressive. And so the difference between a winner take most opportunity versus winner take a quarter, I mean, that is a huge difference when one thinks about it, especially when that delta is actually a key component of your thesis. I mean, their thesis was that the robotaxi is driving the vast majority of the value. If you're going to have to haircut that by 25%, by 75% potentially, because you're going from winner take most to 25%, like winner takes a quarter, like that should warrant a much lower valuation. And keep in mind, this is their #1 position as of today in a couple of their ETFs. So I would call this out as part of the positioning of folks sort of saying, hey, I'm getting a little nervous or jittery about some of the ARK ETFs, particularly their outsized position in Tesla. And Tesla stock has also, fallen sort of in lockstep with these, ETF products. The next part that might be deterring potential investors from sort of plowing ahead into the ARK ETFs is that some of the investors probably don't like, or may not like, I should say, some of the recent moves that they've done. And I can't blame them for this one, because this is a little bit of double dealing, or double dipping, one might say, where here is their Space Exploration Innovation Fund, or ARKX. And you can see their second largest position, this was as of March 26th, is the 3D printing ETF that they also manage. And so it's sort of like, well, wait a second, why are you buying this ETF that you already manage? You're charging fees off of that, and then you're going to be charging fees again for this space exploration one. Why not just buy the holdings in the 3D printing ETF outright for this ETF? So I could definitely understand some investor skepticism, concern that there's potential double dipping that enhances ARK's investment fees by doing this, by effectively getting a fee from this and then taking another one of their funds and investing in it, and that they're charging, they're getting a fee on this and this. So I could understand this being something that prevents investors from jumping in with both feet. So, in summary, as we consider these several different variables, I would say higher rates definitely have an impact, a huge impact on super long duration assets like equities, particularly the unprofitable companies where it's a story of you're going to be profitable 5+ years from now. It's possible to have a rally in the ARK ETFs and the underlying companies. It's possible to have a bounce as bonds, U.S. Treasuries are certainly short-term oversold. Could it get worse? Absolutely. I think the structural problems are definitely there, and the Federal Reserve doesn't have a lot of room to just lower rates from here. You're pretty much at zero. So you need to rewrite this, as Chamath was saying, you need to rewrite thesis based on potentially higher rates in 3 to 5 years from now. I'd argue you need to rewrite thesis if the CEO of a company is telling you you're being too aggressive. That's a whole separate point, because I haven't seen, you know, the Tesla model valuation getting updated for that comment. But this is a key point. If you're assuming, let's say, a risk, a true downside scenario of 5 to 10% inflation, you know, later on, one should consider that when you're thinking about your risk reward. I truly, you know, as a brief aside, when I'm considering valuation models, I truly believe you should be able to summarize it with sort of a back of the envelope. And that's the reason why with most videos where I'm doing a video on a potential multi-bagger, I do that range, and it's a very back of the envelope calculation that sort of says, hey, you know, here's what I would think is a reasonable multiple a few years out, and here's a, you know, upside multiple a few years out, here's a growth assumption. So I get a wide range, and I think that's, honestly, that's the way I think about it, and I think that's the most legitimate way to think about it, especially when, you know, these models can be way too imprecise, you know, way overly precise on effectively the wrong things and be completely wrong. So I'd rather be, you know, imprecise but right than precisely wrong. The valuation expansion of the last 2 to 3 years might also reverse, and that has been a huge tailwind for some of these innovative companies like Tesla, where it's seen its price to sales multiple go from like 3 times to 12 to 20 times back down to 12. So that is a legitimate concern. What if you go back down to where it previously was? What if it just goes back down to 5 times? So that is, I would argue, before you have a true bottom in some of these stocks, you would probably need to retest some of those prior valuations. And investors might not want to see the double dipping that you're currently seeing with that space, you know, the space exploration ETF investing in their 3D printing ETF that's also managed by ARK. So I could understand investors not looking to jump right in based on that. And so I think those you know, that sort of paints the mixed picture of what's going on with the ARK ETFs and when it could potentially find a bottom. These are just sort of my thoughts. But you know, I will also post an exclusive video, for an exclusive educational video on potential bear market busters. I talked about that earlier last week. I'm going to do it. I'm going to film it right after this, where I'm talking about the types of companies that can actually benefit from bear markets, can potentially benefit from tough markets shortly after this video. But that's just one of the benefits of going to unrivaledinvesting.com. Click on Journey, one of the exclusive benefits, where most of my focus with Journey, unrivaledinvesting.com Journey, is to focus on trying to find potential multi-baggers. So you can, you know, once a month I have a full update of my portfolio. Then throughout the month I give updates on anything that's really what I would consider material, you know, in my portfolio, and I do that via posts as well as a Discord channel. And the real aim of all this is to find potential multi-baggers, types of companies that could potentially go up hundreds or thousands of % over time. Because in my opinion, all it takes is finding one potential multi-bagger to really change one's life trajectory. So if you're interested in finding potential multi-baggers, go to unrivaledinvesting.com to follow what I'm trying to do in trying to find these potential multi-baggers. And you know, if you want to see all the exclusive content that I've posted so far, just click on the catalog of contents. It's a Google Sheet that's in the description of this video, and you can see the different tabs, whether or not it's educational or, you know, monthly potential multi-baggers or portfolio updates. And if you enjoyed this video learning about, you know, like when might these ARK products actually find a bottom, start to recover, you know, what are sort of the dynamics that have been holding it back the last few weeks, please make a point of subscribing. If you're already a subscriber, I do appreciate that thumbs up. Thanks so much for watching.